Imagine waking up one morning. The stock market is crashing. Banks are collapsing. Millions of people are losing their jobs. Homes are being repossessed. Panic spreads across the entire economy. For most people, a financial crisis is terrifying. But for a small group of people, it's the opportunity of a lifetime. Because while ordinary investors are selling in fear, billionaires are quietly buying everything. Businesses, stocks, real estate, entire industries. So here's the strange paradox of capitalism. When the world gets poorer, the richest people often get richer. Why? How can economic disasters create the biggest fortunes in history? To understand this, we need to look at what really happens during a crash.
Economic crashes happen more often than people think. The Great Depression of 1929, the dot-com crash of 2000, the global financial crisis of 2008, the COVID market crash of 2020. Each time, trillions of dollars disappeared from markets in weeks. But here's the surprising part. The money didn't actually disappear. It simply changed hands. Think of the economy like a giant game of musical chairs. When the music suddenly stops, most people panic and run. But the players who were prepared calmly sit down and claim the best seats. And in financial markets, preparation usually means one thing: cash, lots of it. During a boom, everything becomes expensive. Stocks rise, housing prices surge, companies borrow aggressively. Everyone believes the good times will last forever. But eventually, something breaks. Maybe interest rates rise. Maybe debt becomes too large. Maybe a financial bubble bursts. Suddenly, prices start falling. And when prices fall fast enough, fear takes over.
Investors rush to sell. Businesses fail. Banks stop lending. Assets that were once worth billions can suddenly be bought for a fraction of their value. This is where billionaires enter the story, because they have something most investors don't: patience and liquidity. When others are forced to sell, they are ready to buy.
This strategy has a famous name in finance: buying the dip. But during a crisis, it's more like buying the entire economy on clearance. Take the 2008 financial crisis. While millions of people lost homes and jobs, some investors made historic fortunes. Warren Buffett invested billions into struggling banks. Private equity firms bought companies at record discounts. And investors who bought stocks in early 2009 saw the market triple over the next decade. In other words, the crash created the opportunity. The most powerful moment in every financial crisis is the point of maximum panic. When headlines scream collapse, when everyone believes the system is broken. This moment has a famous quote from Warren Buffett: "Be fearful when others are greedy, and greedy when others are fearful." During the 2008 crisis, the S&P 500 lost more than 50% of its value. For most investors, it felt like the end of the financial world. But for those with capital, it was the biggest discount sale in modern history. Stocks that once cost $100 were suddenly selling for $40. Entire companies were trading below their real value. And the investors, brave enough to buy, captured one of the longest bull markets ever. This is why crises often increase wealth inequality. During a crash, middle-class families lose jobs, small businesses close, people are forced to sell assets, but wealthy investors are able to accumulate even more wealth because they can afford to wait. Over time, this cycle repeats: boom, crash, recovery. And with each cycle, the richest investors gain more control of the economy. So the next time the market crashes, Remember something important. A financial crisis is not just destruction. It is also a transfer of ownership. Assets move from the panicked to the patient, from the unprepared to the wealthy. This doesn't mean crashes are good. Millions of lives are affected. But it reveals a deeper truth about the financial system. In capitalism, fortune often favors those who can survive the storm, because when the economy collapses, the real question isn't who loses money, it's who is ready to buy.
So here's a question for you. If the next global crash happened tomorrow, would you panic and sell? Or would you be ready to buy? Tell me in the comments.